Okay, so in this lesson, we're going to talk about kind of the aspects of index investing and what are the advantages of it, whether it's right for you or which other approach you want to do. We're going to all discuss that in this lesson. Okay. So for index investing, so you guys can remember, index investing, look, it's similar to like your retirement, really. That's kind of the mentality you want to have in index investing. It's not an amount that you're going to take out in 5, even 10 years. It's something that you're going to look for an actual return of 20, which is like the very minimum. And even 20, I wouldn't even exit out. I would keep it for 40, 50, 60 years. The more, the better, because you guys saw the return in 90 to 80 years. Maybe a person my age who invests into it, if I look by the time I'm 80 years old, I'll be maybe about 70 years later, right? So, of course, I know many people are going to be older than I am. I don't know, people can be really anyone who's 8 years ahead of 8 years older than me or 15 years. Let's say 8 years, it's not much of a difference either from what I'm doing to you. If you just enter in 8 years, you will not get so much of a different return from me. I might have a slightly higher because I'm younger, but that's it. A person who's older, you still get a really good return nonetheless if you actually enter. Of course, probably you won't. Let's say for a 40-year-old or a 50-year-old, you might want to look to take out your money maybe in 30 years, right? But still, if you, that's why I keep saying, if one of the best approaches that I would say if you're looking to take out your money in 20 to 30 years, let's say that range, 20 to 30 years, I don't recommend you to do it per year. I don't recommend you to invest per year. I recommend you to do it dollar cost averaging. I wouldn't even average the position. Why? Because in dollar cost averaging, you're going to be able to get a price, whether it's cheap or not, you're going to get the price regardless. So now in total, you'll get, if the price is coming down and you already entered previously, you're not going to enter that price if you're averaging because you're waiting for a lower price. In this case, you don't even care wherever the price is, no matter how lower or wherever how big the drawdown is, you're going to enter nonetheless. And that's much more beneficial because you'll be able to take in factor of your return, let's say for from A to B. Because look, if remember that example that I showed you from the first time I explained the dollar cost averaging, 125, if you guys remember, 125 to 80 was about a 33% drawdown. But if you dollar cost average, it was really a 16%. So you see how it will obviously reduce the loss, but it will increase the fund, which means that by entering at a cheaper price, when it goes higher or goes back to 125, you actually make a gain because you entered when it was at $80, right? That's the benefit of dollar cost averaging. And yes, you can do the same thing with averaging your position. But sometimes it's just as I said, sometimes you're going to be averaging your position only when it's hitting one of the lower moving averages. But sometimes the price doesn't always bottom at a moving average. Sometimes it bottoms not even hitting the moving average. Sometimes like it's like in the middle between them and it just shoots up from there. Right. So that's like the consequences and disadvantages from averaging position. That's why I'm saying, look, if you're really more urgent to take it in 20 to 30 years, I'd recommend you to just do dollar cost averaging. And for the rest of anyone, if you're going to hold it for 40 to 50 years, if you're thinking of holding it for 40 to 50, 40 to like around there, 40 to 50, I don't recommend you to do yearly investing. I recommend you to either do dollar cost averaging or do averaging position because you have more time, right? When you're averaging your positions, your return will be seen in a big amount in the future, much more by averaging. Why? Because you're entering at longer dates. You're entering less compared to the person who's doing dollar cost averaging because that person who's dollar cost averaging is entering every month, like 12 times per year. So you might not be doing that. Net buying total, right? Because you're entering less amount, you're going to have more of a spread because you're entering at different prices based on where the price is at specifically on a moving average. So you're going to enter fixed prices rather than dollar cost averaging. You're going to be entering any price. It's going to be up and down from 1 to 2 to 3 to 4 to 5 to 6, like all these different numbers. You're going to enter them because it's just per month. Net in total in 40 to 50 years, you will make the return that's, let's say, good enough to expect, right? But I would say 40 to 50 years if you're looking for a return. Anything lower, listen, my advice for you is I don't want you to just focus on a return for 20 to 30 years because that's not the point of index investing. That's really not the point, right? I'm just showing this as for an example for people who are a bit more older and there's no time to start than now. You're never late to start, but you did start maybe a little bit later in some way. But there's no problem with that because my parents did that. They didn't know any of this stuff and they're doing it and they're doing it fine, right? It just means that look, if you're older, that means you need to be more serious, which you are. I'm pretty sure a lot of older people are very serious. They're not the same as younger people. That's the thing that I like about being older because it just removes all the bullshit. You just kind of know what you're supposed to do and you're much more focused about the money. And a lot of the times you tend to already know the responsibility because you already have done that for decades for your children. So yeah, it's just you already know the game. You're going to try to get the money per month. So That's the best thing. The best thing I advise for a person who's older than me, much older than me, that could be 30 years older than me or 20 years older than me, you're going to have to get obviously a bit more money, and you're going to have to invest more aggressively than maybe a person who's younger. And that's just the only way. It's not like, what I mean by the only way is it's the only way to get a really high return, at least. Because think about it, you're not giving enough such a huge room for the S&P. So the best way to do about it is try to get as much cash as possible with as fast as you can to invest it in the S&P 500, and try to lower your expenses a lot more, because that's going to help a lot. Really, the most you can get to get cash, the most you can get, that's going to help you get the return at a shorter time frame, right? So that's the advantage of dollar cost averaging. But I'd recommend only for people who are index investing, who want to get the return for 20 to 30 years, to do it in dollar cost averaging. If you want to get the return for 50 years, that's if in the case maybe you're 15, 20 years ahead of older than me, I would say you can either do averaging position or dollar cost averaging, but I wouldn't recommend you to do year per year, right? Because when you do year per year, you're just investing only once in the year, and you don't get much flexibility on the price. Rather than averaging, you enter several times in the year. But at the end, look, dollar cost averaging and averaging position, remember what I just said, it's both the same thing, sort of. You can do both, whatever's more comfortable for you and whatever's the best approach. So if that's dollar cost averaging, that's what you should stick on. If it's averaging position, that's what you should stick on. Okay. Now for last, if you're somewhat around my age, if you're really young, because I'm really young. I'm really young. If you're younger than me, better, But if you're around my age, look, if you're around your 20s or your early 30s, if you're around my age and you just want to index invest, and I'm going to talk about whether you would rather do this, because look, this is just a part of a portion to increase in wealth, and this is just by the index, right? And I'll talk about what you want to do depends on your expectation, what type of money, and in terms of your emotion, whether you can handle and put in a lot of the work or some sort. But what I could tell you obviously is the surest way to get money is by getting the S&P 500. There's no other way. There's definitely, you're going to make much more sure money than investing in a business, because the S&P 500 is comprised of the biggest companies in the world. That is literally the most surest way to get wealthy, right? So I think a lot of people are wanting to do this, of course, and that's why I'm giving this option too. But you can do all these other options. It's up to you whether you want to do it per year or per month or per quarter. It really doesn't matter. Now, I'm not going to say that doing it 5 years or 10 years is not bad, because you guys did see the return. But look, it's just, if you're able to do it per year, you're actually going to get like a much better return than any of the other, like completely an astronomical return. Because if you did it every 10 years for 93 years, you would have like a return of about, okay, here it is. So every 10 years would be $13 million, right? Since 1928. Every 5 years, $26 million, right? Every year would give you $100 million. You see the difference? That's why I keep saying, look, it's not a obviously terrible thing it's terrible to not even invest. As long as you can invest, the better. But it's even better, and I would only advise you to try to do it every year and not to do it every 5 years to 10 years. Because there's actually let's say, worthwhile, not that the others are, $26 million is really good, but $100 million is a lot better. And it definitely does not hurt to invest. And trust me, it's going to do a lot better. It's much more productive, and it's much more intelligent to invest your money every year than every 5 years. So obviously, if you have like some huge problem, I don't know, that's not personal. Now it depends on every 5 years, but just keep in mind, your return of money is going to be less because you're investing less if you do it for 5 years. So just keep that in mind. That's why I say the more that you can invest in any amount and in any time from tomorrow to the next day, the more you can do this, the more money you will have than any other option, like every week, every year. So that's the whole concept. But I know not everyone's going to do that. So really, the great thing is that you could say universally, really the best option is dollar cost averaging per month, because that can give you a return pretty fast in 30 years because you're investing aggressively every month for 30 years, even so. That's the best approach for that. And it's for the long term, right? For every quarter, you're not going to get the same return as every month, but you're probably going to get a better return compared to every year. And every year you're going to get a better return than compared to every 5 years. And so you see, so, and it depends with dollar cost averaging your position. It's completely up to you because it really doesn't matter. That's why I keep saying none of them are both better than each other. It just really depends which one you find the most comfortable and you're mostly a bit more competent and you understand the most. That's a bit more simpler for you because there's not much huge of a difference. Now, let me explain these few things so we can kind of construct a plan here so you guys can know what the whole point of this. Remember that index investing is mostly for, you can call it really retiring because it's both the same thing because it's a very long-term return. That's for index investing. I recommend that to people who don't really care much about the stock market and frankly don't care much about companies, right? Even if I teach you about companies, if you still don't find much of an interest, which I don't know, that's not something personal. Listen, then the best way to take a use of the market is just ignore everything else and put money into the S&P 500 just as dollar cost averaging or any of the other options depending on your type of goals, the type of amount of time you want to do, right? But you actually don't have to invest in the index. You don't have to invest if you don't want to, because index investing gives you a very sure return, but it's actually a bit. Look, I know it's a lot. Of course, I'm not gonna lie. It's a very great return for the long term. I mean, 400,000 per year, $4.2 billion in 93 years is really good, right? That's really good. But there's actually a bit of a faster way. Yeah, it's just overall faster way. Of course, investing in the S&P 500 is like a no-brainer. A monkey can do that, and it really doesn't require as much work. You don't have to do a lot of the mental work that, let's say, I do or a bit of others. And quite frankly, sometimes you might even have a better return than any of those other people, right? So that's the point of index investing. And I really like that because I think a lot of people are going to do that here instead of the investing in businesses. And I don't have a problem with that at all because I see the return in that. I think that's a great way to get a return if, right, if you're not interested to take a bit of more risk and to try to get the profits a bit earlier, right? So this is where I'm going to talk about this, right? I already explained the index investing and it's only for basically sort of retirement. Now, what I do is I invest in businesses, right? So this is the thing that I love to do. What's the difference, right? Well, obviously a business by nature, right? A business, of course, has a bit more risk compared to investing in the S&P 500 because the S&P 500 has every biggest company in the world. You're going to have less risk in case of a global recession. I don't know, something extreme that it won't affect the markets as much to any individual business, right? So my point here is, look, if you're a very emotional person which I think a lot of people are going to be, if you're a very emotional person who cannot think separately, because I really recommend you, if you cannot think separately from the crowd, because this is what it takes, if you cannot think separately from the crowd, which it means if you're not able to buy at a cheap price when no one is telling you to buy, if you're able to look at businesses that no one is able to look at and see at solid fundamentals despite the noise, if you're not able to do this, go to index investing and forget about any other thing. I don't even advise you to do trading either. I really don't, because trading is a very emotionless game, and if you're an emotion person, you're going to lose all the time doing trading. So that's why, trading isn't meant for a lot of people, and I know that, and that's why I built something like this, because I know it's not supposed to be. So if you're a very emotional person, or who cares to only just get the money that they want to get and guarantee return in the long term for many decades, let's just forget everything else that is in the course about businesses or so, and just stick to index investing because you're going to get a sure return with that. Okay, so I think I've already explained fully 100% for all those people. So you already have yourself cinched if you just want to look for that. However, I do advise you to at least listen, to at least know. If you're an emotional person, at least give a try. There's nothing bad about trying to at least listen to the other things that I'll talk about with businesses if you're able to handle it the right way, right? If you can see that, okay, it wasn't as I thought, because a lot of people have this misconception about stocks that like they don't like to buy because of macroeconomics are not in their favor, when that's not really the case. You shouldn't really care about macroeconomics. You should care about more about the business, right? So you eventually know about this and I'll give you this sort of understanding. However, I'll talk about that later in the other lessons. Like if you're not able to get the understanding, if you just can't, right? What I recommend you is do this model for about a year of businesses or 2 years. And still, if not that your investments, but if you don't enter at right times per se, like if you don't enter when it was undervalued and you're entering based on emotion, of course, I don't recommend you to then much invest into the businesses, because there's now not something between you don't understand. It's now something between yourself. And that's something I can't do anything about, because that has to be something that you have to think about yourself, whether it's really being worthy to be greedy like this or being emotional, right? And that's something now spiritual. Okay, so if you're like this, go to the S&P 500. I still recommend, as again, I'm going to say, I want everyone to listen to what I'm going to say in this one besides index investing. What I do is business investing, right? So business investing has more risk compared to index investing because it doesn't comprise all these companies. You just buy one company. But why do I prefer investing in businesses than investing in the S&P 500? Well, it's actually pretty simple. I don't buy by nature any business, right? So that's what gives me the huge advantage, right? I do my due diligence very deeply and I can determine whether a company is powerful or not. And if the company is powerful, I still have loads of criteria whether I want to own it, right? And if it fills all this criteria, I will then say, okay, let me look at the, where the share price is at. And if it's intrinsically undervalued, right? I don't even care about technical analysis as much. I just buy it. I just buy it really completely as long as it's undervalued because I'm not looking at the short term. I'm always looking at the long term. Also, talking about this, when I buy really great businesses, I never buy businesses that I'm going to get my return in 5 to 8 years. That's not how I go about it. When I buy a business, I by minimum try to find if I can get my return in 10 and at least more than 10 years minimum. A lot of the businesses I own, I know that they'll make consistently more money. I'm not sure because I know that they can. I have a ratio of conservatism that I go, okay, I don't know if this company can make in 50, 60 years. I'm not so sure about that, but I know for sure that it can make more than in 40 years, right? So that's a concept that I have for a very long term. That's just something very basic that I'm giving you mushed up to explain to you so you can understand what I do. That's what I do with businesses, right? And it's completely independent with stocks. In fact, when I look at a business, I actually don't even look at all the stock. I never look at the stock. The only time I look at the stock is like completely after I check everything, like absolutely everything after it was undervalued. I'm just somewhat curious to see where the stock is at. But I do that like the very last because I don't like to get influenced by the stock price. And even so, I don't even get influenced, but I like to go to that measure that I don't like to get influenced because you have to understand that the business is completely separate compared to the stock. The stock price is just the opinion of many people of what they think the company is worth in the short term. But in the long term, when a stock's going up in the long term, it shows that the company's worth more and more and more, right? So I don't buy based on that though. I don't buy if the company's going up, it's worth more and more and more. I only buy literally if this is no different compared to like if you went to a restaurant in the street and you knew it was a great business, right? It was like easily consistent cash flow, no competition, complete dominance, right? And then other factors in terms of high switching costs, etc., and product value, you would buy the business because it's a good investment. It's a really good investment. I do the same approach, no different. That's the same way how I buy stocks. In fact, when I buy stocks, I buy them like if I was fine that they got out of the stock market, right? That they just got out of the stock market and they decided to keep running their business but be out of stocks. Of course, if I'm investing in of course, for right now, I can't do that. And I don't want that to happen because I don't have let's say the credentials or money to get private shares from these companies. Because that's really when the company goes private. That's what happened to Twitter, right? Twitter went private about a year ago or 2 years ago. And everyone who owned Twitter's public company had to sell their shares because the company went private again. This would have not been a problem if you had a certain class of shares that you own actually a percentage stake in the company, right? But you need to have a lot of money to do that. Now, that's what happened to Twitter. Now, the reason why I talked about this is because I said I would be fine if the company went private. But in reality, that would affect me because I can only own public shares. So yeah, but in the future that will happen. Like that's sort of the concept I have, that it goes to show that I don't care about the stock. I care more about the business in general. And that's the way how I buy these businesses. And because of that, that's why I beat the S&P 500 last year by 400%. So let me talk about this and let me explain to you why I invest in businesses rather than doing index investing. But please keep in mind that it doesn't mean that it's better. It's not because of it's better. It's because of what my goal is. My goal is not to have I don't really care about much of a guarantee of the future because I can understand businesses fairly well and I have that competence. I have a competence in the area. I don't know every business, just it's impossible. I don't know every idea. And plus in fact, the reason why I did so well last year is because I didn't swing in a lot of things. I chose to not buy a lot of businesses. I only bought a very few amount of businesses And because of those businesses, I was able to outperform the S&P by 500%. Now, let me talk about exactly why I do this. Because actually in the long term, I'm always going to overperform the S&P 500, and I'm going to overperform inflation combined. Because if I buy a great business, will a lot of the times make huge, let's say, increases in profits compared to last year or 5 years ago, because it's a really good business. It's a business that's constantly growing and getting more customers as it goes on because of their product value, right? Those usually are secular companies. There's other companies like consumer defense, like Coca-Cola or Procter and Gamble, which of course cannot grow the same way how, let's say, Apple grows, for example. Right? Like Coca-Cola obviously won't grow at the same rate as Apple or Nvidia will. Think about it. Everyone's already using Coca-Cola, and they're not like you're not going to have probably 50% more people consuming Coca-Cola out of one year to the other because everyone's already drinking Coca-Cola. And even so, they're products that people aren't hyped up about because they're not products that are going to change the world enormously and do all these spectacular things like technology does, or certain consumer discretionary like Amazon, who has this huge effect on an industry where there's big demand and big consumption, right? Because obviously people consume probably more in overall in Amazon than what they do, for example, in Procter and Gamble, when people buy more products. And not even that, it's just that the product increase from Amazon and their customers to the next year could be higher in percentages compared to Procter and Gamble. And it's not that Procter and Gamble is a bad company, not at all. It's actually a great company, but it's just because of its industry. It's because of of the type of consumption behavior between the two. People are going to obviously consume more of this, a lot more, and buy more things from here at a very growing rate from one year to the other. Like you can have people buying, this is just an example. People could literally buy 1 million iPhones today and buy 5 million iPhones the next year, because it's a company in where they can deliver products to an infinite scale in value, in different features. While toilet paper, for example, you can't do that because what other new inventive toilet paper features are there going to be? There's not going to be much of a difference, maybe in terms of material, but that's not going to increase sales from selling, I don't know, 10 million toilet paper. People are going to consume 80 million, unless if it was like the some pandemic for pooping or something, something like that. That would increase more of the selling. 'Cause that's what happened with Clorox. They sold a lot more, but it was not because of their business and value of a new feature. It was just because of the pandemic. That's what goes on to these companies. Usually this is what I personally do, but it's not what I advise for a lot of people to do. But usually when it comes to consumer defense, I tend to not get a bunch of these companies, because that's the whole point of the S&P 500 for. In fact, it's sometimes a bit more stable to be in the S&P because the S&P already has all these 500 companies. By that nature, I'm not even relying on one company. And in point, the S&P 500 a lot of the times outperforms these companies in the long term. I don't know about Coca-Cola. I have to check. Let me see. Okay, well, there is a difference, but it depends. Look, let me show you. Because it's a business, obviously. Like a business, I don't know about now anymore. I'm not sure. Because obviously back in the 80s, when there was that huge boom of the marketing and the technology, it induced the amount of consumption more. But, that inducement was more, let's say, in third world countries and everywhere else in the world, that increased the value of Coca-Cola. Everyone was already consuming Coca-Cola in the United States, like by 1940s, 1930s. It was already a thing, right? And became a thing internationally by the mid 70s to 80s. Look at this graph. This green line is Coca-Cola, and this is the S&P 500. This is dating back all the way from 1956. So that's about like 70 years, almost 70 years. In 70 years, Coca-Cola has done 25,000%, while the S&P has done 8,500%. That's a huge difference. But if you look way before, look, they're almost the same. So you see, so like sometimes it depends. Obviously, it depends. So that's why I keep saying holding consumer defense. I do hold consumer defense, but I don't hold a lot of them because they've already been companies that have been strong before and that are already strong. But the increase in sales compared to Coca-Cola back in the 90s are going to be much less compared to before. Not because Coca-Cola is a worse company. It's just because everyone's already consuming Coca-Cola more than ever before. It's because everyone is already consuming Coca-Cola more than ever before. Right? And I don't know, there might be some new technology invention in order for people to consume a lot more Coca-Cola, but it'll be like somewhat of a cyclical thing. All right, so that's the value. But despite this, that's how I invest in businesses. And look, if you compare this to example for, I don't know, if we compare this to, let's say, Microsoft, or sorry, let's go back to the S&P. I was just going to compare it to Microsoft. Yeah, look at the difference. This is why I like to invest in companies in the long term, right? Look, Microsoft, since let's say back in the 80s, because I hold these companies like if they were 30 to 40 years later. So in the 90s, let's say in 92. Look, Microsoft made about 13,000%, while the S&P made about 920%. That's about 13,850 divided by 920. Look, the Microsoft has outperformed the S&P 500 since the 90s until now by 15 times. So a person who invested in Microsoft is about 15 times more wealthier than the person in the S&P. So this is why I do businesses. It's because I can get a better return. And I can frankly get a better return in the short term and in the long term compared to the S&P 500. Because these businesses are making much more money in terms of increase in percentages, like increase in sales or increase in cash flow, increase in product value at a faster rate from 0 to 100 compared to the S&P 500, who's already factoring many different companies that could be making a lot of money, making somewhat money, and making adequate amount of money. So net in total, you have like a balance there. But because of that balance, obviously you have a lot of stability, but it won't give you a high return. Now, I don't know how Microsoft in the future, whatever happens, but now that Microsoft has delivered, because Microsoft has done 0 to 100. Rather, the S&P has done maybe, I don't know, 50 to 100, because it already has a track record of many of these companies staying in. But again, there's not one that's better than the other. Remember that. That's not the way how it is. It's not one better than the other. It's just that the amount of money I know if I invest in businesses, I know I'll get more money out compared to if I wasn't investing in the S&P 500. And I'm not going to hold something. I am going to hold it, but I just have a goal, right? I have a goal of increasing my net worth hugely. And the biggest way to do it effectively is to do it on businesses. Of course, remember, if you're already a millionaire, remember the example that I showed you, if you have $10 million a year and you just put 40%, 90 years later, you have about $42 billion. You don't even have to do maybe a lot of this. But the great thing that I like about investing, and here's the difference. The great thing that I like about investing, specifically just investing, is that you can get to that $10 million and beyond that in just in a matter of a few years head on, because of the type of quality investments that you can do. You can't do that in the S&P 500, but you can get that maybe 10 years to 20 years later. And rather, I can cut short that process maybe by 70% less. And that's why I like to invest in businesses. It just goes along with my game plan, right? So I think many of you are interested, because that's why I've showed during if you guys remember the free course, I showed you the difference between investing in the S&P and in businesses. You can see that the average return per year in a business, which is a very sort of black and white, but it's an average return of about 20%, while the S&P was about 12 to 10%. So, or no, sorry, the business was about 25% per year by average, and the S&P was about 12 to 13% or 15. So that's quite a bit of difference. It's quite a bit of a difference. So that's the difference, right? What I recommend for everyone, of course, you're not going to know right off the bat whether what's good for you. Just keep on listening to what I'm saying, right? That's why I've always said, like, when you're in the course, I don't want you to immediately invest when I say something. Wait until you complete the course and then start doing it, right? If you completed the option trading course, start doing that. Just start seeing it, because there's nothing more in whether you can do something than completing it, right? So complete first the option trading, and you can also do simultaneously the investing, right? But just complete the option trading. If you started first the investing, the same thing, finish the investing. But I recommend anyone who's watching this, just listen, and we'll show to you, all the different ways of how to invest in the business. And this is now my world that I love a lot. I do this every day. I look at businesses, right? Strong company, super strong company like Apple, phenomenal company. And yeah, those are the differences, right? But there's no one best than the other. It's just my goal that I like to do. So maybe my goal can be the same as yours, and you might want to invest in businesses as well. But your goal might be different from mine. Again, let me repeat again. If you invest in an index, you really are not ever going to worry about money ever again in the future. But like, that's in 50 to 60 years, right? And you have to be fine with that, right? You have to be fine with 50 to 60 years, and maybe you can be working a job that you really like, and in the future that can pay off your other expenses and whatever the hell you want to do. For me, of course I care about that, but I can really do that with the businesses I do. But that's because I'm competent at what I do. I understand a lot. Remember, if you're emotional and you can't seem to enter fact, and you can't seem to do things without other people telling you to, because I want you to do that. I don't want you to be dependent on me. I don't want you to wait for me to tell you what business you should invest into. No, 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 no. That's not the point why I made all this course. The whole course is that I can teach you how to fish and you never have to ask anyone else how to fish ever again, right? When you ask someone later on, you're going to find different methods to probably, I don't know, somewhat make the hook shorter and catch a particular fish. But you're going to know how to do the basics of fishing. You don't have to relearn it again because you know how to do it. That's what I'm doing with this. So, but if you can't, because face it, you have to just be honest with yourself. If you can, if you've done it, I recommend you to try to do this for years. And simultaneously, what I recommend is do this for years. And if it's too hard because of yourself, but you really understand it, but it's too hard and it's not because of yourself, because you're emotional, forget about this. Forget about the business investing. It doesn't matter because you're going to be able to invest in the S&P 500. That's all the 500 biggest companies, and it's always going to show up the most relevant 500 biggest companies in the next 10 years, and it's going to switch to the next 10 years, and it's going to keep switching, and it's going to keep going up, right? So you're guaranteed to make money that way. In this one, you are guaranteed to make money if you know what you're doing. When I invest in a business, I'm not saying that I have an 80% chance that I'm going to make money. No, I have almost 100% chance that I'm going to make money. That's how I go about in investing. So you can tell that I don't invest in a lot of things. That's why I did so well. Because I don't invest in the 10% of the 500 companies in the S&P 500 because a lot of them aren't worth it. They're not the best companies. I invest in the top less than 1%. I invest like in less than 1% of the 500 biggest companies in the world, like much less than 1%, sorry. Because in that less than 1%, there's going to be actually opportunities of companies that are not looked, that are overlooked, and that are underestimated that I can enter, and I will do very well with that, right? So that's the mentality. But you don't have to do this, right? This is why I keep saying I want to create variety. You don't have to do this, but it's a great way to become wealthy. And I'm going to talk about that eventually, that, what's the difference from trading and investing. Investing is a sure game. All right, that's all I'm going to say, because I want you guys to learn this. It's a sure game that you're never going to lose your money. I really recommend anyone who's in the stock market to have more of their money in investing. Have more of your money in investing, because that's money you're going to get for sure later on in the future. All right, that's the end of this lesson. I've already summed up the difference between index investing and business investing, but stay with me so you can learn and understand, okay, what's good for you, right? And I'll guide you further on later.